our second quarter of 2025 market commentary. Hello, Tariffs. That's what we're going to talk about today. But before we get there, we need to remind our listeners that the information discussed in this commentary is regarding Consilio Wealth Advisors' view on the relative attractiveness of different areas of the market contrasted with our current asset allocation strategy for the near term, which we consider to be 12 to 18 months. The views that we share here are to be digested in the context of a well-diversified portfolio and are not meant to be a recommendation to buy into or sell out of a particular area of the market or stock. We commonly discuss single stock names on this podcast. We are not advocating for buying into or selling out of any of those stocks that we talk about. And finally, our views can and will change as new information becomes available, and as a result, we will periodically update this brief to keep you all informed of changes. With that, I will kick us off with an agenda for today. As usual with this commentary, we're going to run with a summary of the newsletter that we put together that is posted live on our website. So you can watch, listen, or read, or all of the above if you want to get the information 3 different times. All of this information. I'll just set the stage here, and then I'm going to turn it over to How to run us through the commentary here. So we're going to start with a review of Q1, and spoiler alert, we're going to cheat a little bit. Q1 ended March 31. Liberation Day was April 2nd. So it's just not fair.
It'd be funny if we just stopped talking about Liberation Day.
Yeah, we just be like, Q1 was great. Markets were up. Unemployment was low. Inflation was low. Earnings was at an all-time high. Okay, we had to cheat a little bit and extend out a couple of days. So we're going to give you some good data. Okay, crazy. Ice cream truck is going.
Yeah, I'm hearing it. It's a school week, a school day, right? So why?
Bad timing, bad business. That's funny though, because when I grew up, it was like an old mail truck looking thing. It's like more of a hybrid these days. Wow, 2025. Distraction. Okay, speaking of ice cream trucks, we're going to talk about cars and tariffs after the Q1 review, and then we're going to move into bonds and interest rates. That's probably going to be the meat of our chat today. And of course, we're going to look ahead into the second quarter and give you our thoughts there. So with that, How, let me turn it over to you. Let's start with our first quarter review.
Yeah, as Chris alluded to, we're probably just going to talk about Liberation Day up till now. Liberation Day was teased by Trump saying that he's going to announce tariffs. And the White House said they're going to say these tariffs are reciprocal in nature. So, if example, China tariffs us 10%, just using examples, we're going to, as reciprocal, the definition of it, we're going to say 10% tariff on Chinese imported goods to the U.S. So there's an expectation set up, right? So Liberation Day came, and this big board was held up, and there was China, but the I think I have it on the sheet. No, I don't. That was on a different one.
Yeah, you put it in one of your newsletters.
Yeah, I believe China was as high as 50%. That's with a 50% discount, because that's what you do in tariff wars is you. I'm being sarcastic here, but you tag a certain number and you cut it in half, which doesn't make sense.
Just for context here, quick, this is How's article called "Making Sense of the Tariffs." So if anybody wants to check that out, it's on our website. It probably would have been in your inbox as well, but it was posted on April 15th on our website. If you go to the Insights section and then Consilio blog, you'll find that pretty high up. It's a pretty recent article, and you'll find what probably will be a famous shot of that board that was held up. That's snipped here in the article.
I guess that's really the actual numbers are probably not important, but it was the degree to which those numbers were posted was important. And so they went beyond reciprocal, right? They went and included a trade imbalance, and that included Vietnam was 90%. The board said Vietnam had a 90% tariff against the U.S., which is not true. It's 9.5. And the calculation included how much we spend on Vietnamese-made goods versus how much they spend on U.S.-made goods. But if you line up Vietnam with the USA, you're talking a multi-trillion-dollar country,
Yeah.
the U.S. versus a few $100 billion country in terms of economic power. So the average wage of a Vietnamese citizen is about $8,000 a year. So they're not buying things, period. They're not spending the way we spend, right? So I think that's where the trade imbalance was so misleading and so unexpected, and that's where the negative market reaction came from. So the S&P during that day touched at negative 20%, which is officially a bear market. It lasted about a day. The NASDAQ bottomed at negative 23%.
20, and that's 20 from the prior high, correct?
Yeah, correct. From the previous high, which was mid-February. So I think the Liberation Day set up one expectation, but when reality set, it was below expectations in terms of a negative point of view. Does that make sense, Chris? Where the market's all about expectations, and when you bring reality that's better, awesome, right? Or you bring reality that's worse, that's even worse. So right now we have quite a few tariffs repealed, and I think that's the other issue. It's not consistent. A few days later, I believe on April 12th, the administration pulled most of the tariffs off the board and kept and increased the Chinese tariffs, which I believe is the most out of any country. But I believe we still have the universal tariffs across the board, along with the 25% steel and aluminum tariffs.
Yeah. There was the pause, and there was some exceptions, and there was a pause on everything but China, right? That was the one that ultimately became into focus here. So, yeah, just a quick tangent. My dog's beneath the desk, and he's like snoring really loud, so the mic
no,
sounds good.
It's not me, I promise.
You could hear the ice cream truck, but I can't hear your dog snoring. So
okay,
that sounds
okay.
Good.
Now people are going to start listening for it.
Yeah, don't hear it.
Okay. All right. So that's basically what happened. That's what's causing the volatility. We have, as of April 23rd, after the market closed, we've recovered a lot of those losses. And right now, as it stands, the S&P is down negative 9% for the year, versus the 20% that I quoted earlier.
Yeah, there was. So let's see. The market slid like 10% in 2 days, right? Because Liberation Day was after market close on Wednesday. Thursday was down. Friday was down. And then was it Saturday when they announced the first pause? And then Monday was ripped up. It was something like that. And it ripped up. It was it the best day in NASDAQ history? I'm forgetting.
Second best day in NASDAQ history since COVID. COVID was the first out of its history of the index.
COVID wasn't that long ago in the grand scheme of things. That just shows you the magnitude of this, right? Like the magnitude of what was announced, and then ultimately the magnitude of pausing that announcement and the effect on stocks. It's been a crazy couple weeks. I was just meeting with a client earlier, and this was like 3 weeks ago.
It felt like a lifetime ago, doesn't it?
Right?
Yeah.
Like 3 weeks ago. I mean, Wednesday the 2nd we're recording on April 23rd after market close here. 3 weeks ago was Liberation Day. It's like, wow. We've had a lot of market activity in those 3 weeks.
Yeah, and if you closed your eyes and just was looking at your portfolio, headlines aside, you might be pleasantly surprised at how little your portfolio seemingly moved.
Can you speak to that? What areas are doing okay, and what areas have sold off?
Yeah, the areas that have done pretty okay were international, precious metals. I know gold has definitely hit the headlines. We'll talk about that. But bonds reasonably held up. They're flat for the year, but we'll talk about U.S. Treasuries more. So it was basically U.S. stocks that have been the most punished.
Let's go ahead and shift our gears to cars and tariffs, just taking us into our next section here.
Yeah, I use this kind of like a proxy for a lot of imported goods, right? Cars are just easy to envision. So I pulled an article from Sherwood Media, who pretty new finance outlet that actually has some pretty good quality stuff. So they have an automaker's response to tariffs chart saying they're either going to raise prices, lower margins, meaning they're going to take a hit to their profits, they're going to lay off, or they're going to shift production seemingly to the U.S., right? That's the idea of a tariff working, is you bring factories from overseas back to, home soil.
Right.
And then outright halting imports. So the automobile manufacturers here are Ford, GM, Stellantis, Toyota, Volkswagen, Hyundai, Honda, Nissan, BMW, Mercedes, Mazda, Ferrari, and Jaguar. Majority of them, outside of GM, Ferrari, and Land Rover, and Volkswagen, are coming out publicly saying that they're going to lower margins or they're going to reduce their profit expectations. So as shareholders, right, that only goes so far, right? I think that's an issue if it becomes persistent in a already tight margin, industry. Apply that to airlines, apply that to retail, right? Anyone who sells a good, your margins aren't 50% like NVIDIA, right? I mean, even NVIDIA is getting crushed. So lowering margins, I think, could be temporary because there will be a shareholder revolt, right? And that's probably why the consumer discretionary side of things have been hit the most, which is where a lot of the automobile makers are in, right? Two have said they already raised prices, Ferrari, so, out of reach for me and you now, Chris.
Oh, good. So they're 25%. They won't be lowering their margins.
Yeah, 25% price increase for Ferrari buyers. And then
that actually
Volkswagen.
makes sense because those customers are not price sensitive, so who cares?
No, they're not. Yeah, who cares, right? And Volkswagen, surprisingly, is raising prices. And that's not to say they're going to raise prices by a full 25%. Volkswagen, going against the grain here, if they raise the prices, people are going to go to Toyota or GM or Stellantis, right? They're going to lose on volume. So there's no winning depending on what you do here. So the other options are shift production back to the U.S. That's GM, Hyundai, Honda, and Nissan. Building a factory doesn't happen overnight. I know Intel had broken ground on the Ohio chip plant. They did about a year ago. That plant's not going to go or be ready to be occupied by 2030. And that plant also will not be producing any chips until 2032. So we're talking over 8 years of building and construction. And who's going to be the president by then? Who knows? And I think that's the issue is unless GM has some idle plants that they just could flip a switch, which I doubt, right? They have to retrofit this stuff, even if it's somewhat ready to go. That's an issue, right? That costs money. Filling these plants up with people, more likely it's going to be robots filling them up. I think that's another issue is you're not really saving jobs. You're probably creating jobs if you know how to fix the robots, right? If you're a technician, not necessarily an automobile manufacturer. Does that make sense? All right, last column, halting imports. It's Volkswagen, so they're going to reduce the amount of Volkswagens available for sale. So if you're a big VW fan, well, the prices are going up, right? I think that's the issue. Mercedes-Benz is also in there, and Jaguar, Land Rover. They're just going to stop selling their cars here. So,
I remember seeing that in the news. It's like, wow, these are big. Mercedes is a luxury brand, as is Land Rover. I'm shocked that and I'm sure that the U.S. is their biggest market for their biggest cars. Like I believe BMW has an X5 plant in like North Carolina or something like that because they sell so many X5s into U.S. markets. Nobody else buys them, right?
Yeah. That's for assembly, though, too. Where are those parts coming from?
Oh, totally.
Yeah.
Totally. But I'm just saying, I'm shocked that they would halt U.S. imports, because I would be just betting that the U.S. is where they're getting a lot of their margins from. But I guess
Yeah.
it's a business decision. It's interesting.
So you could apply that to really any industry. If you think about, the goods that Walmart, Target, Costco import in, right? A lot of these decisions are being made right now, and a lot of the price increases will flow through if they can. That's a big if. But if you're an investor in one of these companies, you want as many price increases to flow through to the consumer, which is kind of that tug and pull that we're facing.
Let's shift over to bonds and interest rates. I think this is some really interesting stuff here, and we just got a lot to unpack with what's going on with bonds and rates right now.
Yeah, treasury bonds are not reacting the way or behaving the way we expect them. So we do have data going back to the great financial crisis, the housing crisis. The S&P sold off initially 37%, so negative 37% in 2008. 20-year U.S. Treasury bonds were positive 34%. Generally, people sell their risk assets in times of volatility, and they buy safe haven assets, which in 2008 was considered the U.S. Treasury. Fast forward to COVID, Treasury bonds were positive, let's call it 18%, rounding up, and the S&P was down 15% during COVID. And this was in the bottom of March 9th, 2020.
Can you just take a step back and explain why that happened? So why do rates move generally when stocks sell off?
Yeah, so going back to the simple phrase of more sellers than buyers, or more buyers than sellers, if you think about U.S. Treasury, more demand, more buyers come in, that pushes rates down, because the U.S. government doesn't have to induce people to buy U.S. Treasury, because the rates are at a good level where people want U.S. Treasuries.
Yeah.
And that has a lot to do with credit, stability, all that stuff, where, you think of a safe haven, you want your money to be somewhat safe, right? So now, on the flip side, if you have more sellers, people experience it with stocks all the time, right? There's more sellers than buyers, stock prices go down. Same concept happens with U.S. Treasuries, where you have more sellers than buyers, interest rates actually push up. So what Chris is segueing us right into is what happened this round for tariffs. We had the 20-year Treasury that have shown positives really in any stock market event going back to the 1940s, 1950s, where treasuries rebound, the prices rebound because there's so much demand, interest rates go down. That's really the target of this administration. That's what they were really trying to do with all this tariff noise, was bring rates down. They have about $8 trillion estimated of U.S. debt that needs to get refinanced this year alone, out of, 32 trillion of total debt. It would be nice to refinance when rates are low, right?
Yeah.
Because you're paying a lot less interest. Right now, we're paying $880 billion a year in interest payments alone, like nearly $1 trillion in interest. And if $8 trillion of that rolls over, but we need to refinance it because we don't have any kind of surplus, we want rates to be low when it comes time to refinance.
Yeah, definitely.
Or the problem is a lot of these bonds were issued in 2020, 2021. We're going from 2% rates to 4 or 5% rates, which is not good. And that's what they were trying to do. Lower rates also spur borrowing, right? Makes sense because everything goes down. Hopefully mortgage rates go down. That's not really what happened, right? So the administration tried one thing to bring rates down, and it blew up in their face. The price of the 20-year bond dropped by 3.43%. In percentage terms, like what's happening to the interest rate, it went from 4% to upwards of 4.5% during this whole ordeal. So not only did they
huge movement.
Yeah, trillions of dollars worth of impact there.
I think that was the largest movement in the 10-year in history.
In the span of a few days, yes. Yeah, that's what caused that to the liberation from Liberation Day.
Yeah.
It's the administration saw what happened to the bond market, where basically there were more sellers than buyers. I'll get to what that could be, where it put more sellers pushed the rates back up because there was less demand for the U.S. Treasury bonds in moment of crisis.
Everybody that's just listening to this, just make a note to go to our website and look at this commentary. So pull it up. It's going to be under our insights section on our website, and then under market commentaries. It'll be posted by the time you're listening to this. And I just want to direct you to these 3 charts that Howe just talked us through. You got to see them. You got to see the chart of the great financial crisis when we're looking at the S&P 500 versus 20-year Treasury bonds. You got to see the chart from COVID in a snapshot, and then you got to see the chart from what we just all experienced. A little bit of uncharted territory.
I could point to 2018 as well. Same behavior.
Yeah,
in 2018 was tariffs as well. Really, any market event that you could think of where stocks went down, I can point to something that went up, and 95% of the time, that something that went up was U.S. Treasuries, except for this one time. So I think the gambit did not pay off, and I think that's why you're seeing the backtracking of all this tariff stuff.
Yeah, so let's do we have any data? I know there's speculation for sure on what that selling pressure was, but do we have any hard data on what happened?
Not yet. So let's dispel some of the rumors where international holders like China specifically can really inflict a lot of pain if they unloaded their treasuries. Yes, they could, but as a foreign investor in U.S. Treasuries, you're taking 2 transactions, right? First, you're exchanging your currency, your home currency, to U.S. dollars, which is one thing. Then you're buying U.S. debt. So if you're selling the U.S. Treasury and therefore converting the U.S. dollar back to your home currency, you're either going to, depending on how you do this, because you need to be very orderly about it, is you're going to either severely weaken your currency, which would be pretty bad, or you're going to severely strengthen your currency, depending on how the winds blow. So that kind of rules China out. They're still holding about $800 billion in U.S. debt. Japan is the largest single holder of $1.2 trillion. How
does Japan hold so much of our debt, by the way? It seems like such an interesting thing.
I think it's part of a trade deal. Because what's their biggest export? That's kind of like exposing all the stuff we talked about.
It's our credit.
Yes.
I mean, it's these foreign debt holders that are financing our government, right? Yeah. We run a deficit, and when we show up, to come back to the conversation you had earlier, I like to think about it as people in the room, right? If I need $1 million and one person shows up and says, I've got $500,000 of capacity, I've got to push interest rates up to get another person or 2 in the room to satisfy my demand. If I, on the other side, say I need $1 million and $10 million worth of pockets show up, that pushes interest rates down because it's just people are clamoring for that debt. Yeah. The U.S. has enjoyed this more or less clamoring of over 2 times the amount of buyers in the room when we're selling debt forever.
2.5 to be clear.
Thank you. Which is what ultimately holds our rates down. Which is what propels our economy, which is what finances our government. I mean, this
our
is
growth, everything. Yes.
Yeah, exactly. So in a way, not even in a way, factually, it is these foreign countries that are really powering the U.S.'s ability to finance everything, which isn't just, by the way, the government, financing the government's deficit. This also trickles down into you and I buying a car or buying a house,
mortgage,
or financing some other transaction. So that's why this is so impactful.
That's the big punchline, right? You probably were rolling your eyes when I said it was half a % move upwards in treasuries. That does not happen in normal markets, right? Even when they have catastrophic causes like the great financial crisis, the housing crisis, rates go down, right? And that's kind of been the mechanism to re-spur the economy, or reinvigorate the economy after it's been down in the dumps. So the issue is about two-thirds of U.S. Treasury debt is owned by U.S. citizens or U.S. companies. But that 1/3 is still a ton of money.
It's a lot of money, yeah.
Yeah. So if anyone really wanted to punish Trump, despite their own currency, which they would never do, it's kind of like the a standoff where guns are pointing at each other. You shoot me, I shoot you. Trump definitely shot first, but he shot himself in the foot twice. Mm-hmm. I think that's the issue, is climbing out of this will be just as simple as, hey, no tariffs. But the reputational damage might drag on more to a point.
Yeah.
Right.
I mean, and let's shift into looking ahead here, because, I think the fundamental question is, when all this is settled, which it'll happen, right? We know that tariffs are not going to be 125% on or 145% on China or whatever forever. When all this is settled, do we just go back to business as usual and companies continue to earn and cars get sold and interest rates just go normal and the Fed starts lowering again? Is it business as usual, or is there something fundamentally that's changed here that's going to change the demand for U.S. debt, which could be a long-term trickle-down effect? So I don't know that we know the answer to that yet, but that's fundamentally something that's a challenge.
Yeah, I think fundamentals, there has been flows to more buyers to German bonds. But look at Germany's economy. They don't have a ton of debt.
Right.
One U.S. insurance company who wants German bonds is going to buy German bonds. The market's completely dry now.
Yeah.
That's how small it is relative to the U.S. bond market, treasury market specifically. So, one, German bonds probably aren't the answer. Gold is probably not the answer. Gold levels here, it's looking like it's a more speculative asset than anything, right? It's been pumped up in the last 3 years. I get it, but gold doesn't behave the way people think it behaves, and it's still pegged to the dollar value. So that, in a way, is me saying it. We're the cleanest shirt in a dirty laundry basket.
We've been saying that for a long time.
Yeah, I think the money will have to flow back to the U.S. just because of capacity, right? Because people aren't buying euros. Yeah, they're not buying Chinese bonds. They're not buying Japanese bonds, right? Where are they going? Canada? Mexico? No. Combine all those countries together, it's still the U.S.
So as we look ahead, that's kind of what you're saying. That's your outlook, is that ultimately it'll have to start to flow back because of just simply the demand for debt, and there's only a handful of companies that can satisfy that demand.
Correct.
Countries. Excuse me.
Not even a handful. It's probably one. Yeah.
I was listening to another podcast. I hope I'm not misquoting this. Canada's economy is only about $2 trillion.
Yeah.
And they're you're talking about, I don't know what California's economy is, but it might be more than that.
I believe California's was $8 trillion. I'd have to double check.
There you go. Right.
Yeah.
So it's just I didn't realize that, that some of these countries have really small economies. I mean, there's only a few big economic powerhouses. It's the U.S., it's China, it's India, up and coming. I'm giving a very abbreviated list, but I didn't realize that some of these countries were actually so small in terms of their economic output.
To be clear, California's $4 trillion, a little bit above $4 trillion.
There you go. See, and that's my point. If ultimately the world says we're not buying U.S. debt anymore, we're going to buy Canadian debt. Let's say that's the next best thing. They would run out. And frankly, the amount of demand they'd have would push their interest rates to zero. So that's another whole conundrum.
Yes.
Maybe that'd be good for them.
Yes, it's all interconnected. It's so wild how all of this has exposed that.
Yeah, no kidding. In remember, see above, 3 weeks. It's only been 3 weeks, folks.
Yes.
Okay, so let's have some fun as we wrap up. Give me a bull case and give me a bear case for all of this. You go first, and then I'll go.
Bull case, the volatility washes away because we somehow come up with these trade deals. To be clear, 3 weeks later, after Liberation Day, not a single country has come to a trade deal with the U.S.
Officially? Because I've seen quoted there's a bunch of deals happening or whatever, but nothing official.
Nothing.
Okay, fair enough.
So, one, similar to what happened in 2018, it took about mid-February after the tariff announcements in 2018, in a kind of very similar path, the stock market was down 20%, and it recovered very fast. That's when we slapped tariffs against Canada and Mexico. And then the world just kind of forgot about it. We came to an agreement that was exactly the same as the first agreement. So why even rip the first thing up? But here we are. So I think that's a bull case. We might see some volatility. I would expect more and more volatility, but I do expect us to recover relatively quickly.
Yeah.
Most importantly, the world does see the U.S. debt specifically as a safe haven asset. The rates come down. We're looking at 7% mortgage rates as we talk. This is crazy.
Rates came back up.
This is so crazy. And when you have a market sell-off like that, you want people to buy homes. I think we've been saying this, me and Chris, 5% psychological mortgage rate. People will feel okay. They won't feel great. They'll feel okay about trading in their 3% and upgrading.
Yep.
How about you?
No. Give me your bear case. That's your bull case. Give me your
bear case. Bear case tariffs go through, and we onshore all this low-wage paying jobs in areas that we don't have qualified workers. One of our partners lives in Arizona, and Taiwan Semi has a ton of vacant jobs in their newly opened plant there.
Is it Taiwan Semi or is it Intel?
Taiwan Semi in Arizona, Intel in Ohio.
Okay. I keep saying the wrong thing. Yeah.
Taiwan Semi does what Intel does, is fabricate chips, and they built a massive factory in Arizona. Not enough people who want to work there.
Yeah. Which means what? Wages go up.
Wages go up, or you got to find robots to replace that work that you couldn't get in the first place, right? So that's a bear. Yeah.
This could be the acceleration of robots and AI too, because we need stuff done in these factories, and if there aren't people to do them, this could be a huge acceleration of that. Yeah,
and to be clear, I'm probably the last person to dismiss worker livable wages. Like, you look at the Rust Belt, you look at Detroit, right? I'm watching the show. They're driving muscle cars down vacant streets because no one can live there because there's no jobs. That sucks for the American dream, right? I don't know if that's the answer is getting those people back in factories, but I think the answer is somehow giving them a livable wage that they could be, they can bring some respect to. Versus, I said something about not wanting my kids to work in a Nike factory. Is that the American dream? I don't think so. And I think these tariffs will kind of somewhat force that down our throats unless we don't automate. And I think the job vacancy thing is real. It's just because we have less people. There's less younger people filling in behind us.
All right, my bull case is similar to yours, and it's that ultimately what comes out, because we know there's an announcement coming, right? We have this 90-day pause, and announcements coming with hopefully a bunch of trade deals, right? And then and hopefully those deals are what the market is anticipating. If they aren't, we're back to where we are, and things sell off again, right? But to the extent that it happens, I think we ultimately land somewhere south of 10% on this global tariff thing. It seems like that kind of is the number. In fact, that was the number that has been kind of communicated by like economists and whatnot on, hey, I don't support rates above 10%, this kind of thing. So like, I think we land somewhere with kind of a global rate of somewhere sub 10-ish, with some carve outs for certain countries that are probably more, I think, i.e. China. And then I think certain products that we're trying to get back into the U.S. for, let's just say, national security reasons, I think is the main pull of the administration. I think you're going to see higher tariffs on those. So I think it'll be much more targeted. And I think that finality, as long as it is reasonable, matters less. What matters more is that it's final, and it is more, it creates more certainty. I think we're going to see a record number of companies pulling their guidance for the remainder of the year here in the upcoming earnings season, because CEOs literally don't know how to plan with an unknown business environment. As that goes away, I think you see stock prices go up. So that's my bull case. I think we go back to sort of normal, at least for a while, and hey, maybe it even does spur some U.S. investment, and you start to see more announcements here of plants and whatnot.
Yeah.
Speaking about auto, I mean, there's a ton of auto workers out of work because there's been so many plants that have closed. If we can get Mercedes to bring a plant here, put it in Detroit. I mean, one of the cool things about Rivian is they actually build their cars in Detroit. That's cool. Versus in say California. So like it potentially is taking jobs or, giving back jobs to that community.
Yeah. Or another bull case, open up the Chinese market to a fair chance at it, right?
Yep.
Because it's wildly imbalanced. I totally get the need for slapping China around because, they have a lot of unfair business practices that need to come down.
Mm-hmm. My bear case is that everything I said is totally wrong. Basically, what is announced is nowhere near reasonable. It's extreme. We're touting the amount of tariff revenue that we're going to collect. It doesn't show up in the data. Inflation spikes. Layoffs happen. CEOs are saying, I need to protect my margins. So therefore, I need to increase prices a little bit and I need to lay off people. We get unemployment to spike and we fall into recession. I think recession is a coin flip at this point. It's certainly viable. It would be unfortunate to go from 3 weeks ago, again, literally peak earnings to recession in 3 weeks. Arguably in 2 days, actually, because we were there, didn't know it. So that's my bear case. And then where does that go? We're in recession. Our interest rates maybe stay high. So now we have high interest rates. Now we have
you can't spend our way out of it, right?
Can't spend your way out of it, right? And is this administration going to be okay tacking on more debt to stimulate the economy when one of their biggest mandates is to reduce the debt and reduce the spending? That's tough. So that's, I think, the spiral of the bear case. That's what I got.
So the issue with the stock market is it probably already has assessed the probability of both scenarios, the bull and the bear.
Yeah, fair.
So the range of outcomes that Chris and I described can happen. We see there's like a line to it, right? We're not just making it up. And I think that's the issue is the wide range of outcomes here. I'm trying to be the optimist there. I think things will work itself out. Like greed will eventually win.
Yeah.
And I think the realm of possibilities of the worst case scenario, which Chris described, is stagflation. We haven't seen that since the 1970s. If that really happens, that could take a lot to climb out of.
Mm-hmm.
Because you need to rebuild reputations, you need to knock down tariffs, you got to do all kinds of things that would take time to rebuild.
And we've only had this administration, for 3 months. So
it feels like 30 years.
So but I say that because if we do have that outcome, will they then relieve the policies that they just put in to try to stimulate the economy? My take is no. Because it's a real, all the work and all the trade deals and everything. And then they're going to say, okay, we're going to just pause tariffs because, we think it'll jolt the economy back. Like, they're not going to do that. In a way, you can't do that. You have to kind of save face. So
yeah, you lose if you do that, right?
Yeah. So, we ended on a bad note. Hey, that's okay though. Well,
I think greed wins.
I think the fundamental point that I want to repeat that you said that I think is valid, and I've heard this a number of times now, the U.S. really does have the U.S. is in a unique position because of the demand for our debt. Could that change? It's plausible. Yeah. But that's the thing, is that it in theory can only change for a short period of time because, as you say, Germany can't even issue enough debt to satisfy the world's demand. And so in a way, it does circle back to these big nations, which come back to, stability. Hopefully we can come back to that. So anyway, that's my thought. Anything else to add?
No, I think get invested, stay invested.
Fair.
The market rebounded a full 10% in a matter of, let's call it 2.5 weeks. It's crazy how things are whipsawing. I know it's hard to ignore. I'm not saying ignore it. I think that's a very weird skill set that some people have. And I think, yes, you're paying attention, you're scared. I admitted to Chris on Liberation Day, I was up at 4 a.m. because I couldn't sleep, because I just knew it would be a bad market response, right? And I think that's something that we all go through, but we didn't scream sell. We actually screamed to invest more money, and because prices are lower, and you strip away all the headlines, I think I'm standing by my year-end prediction. I think people will forget about the topic of tariffs.
Yeah. We will do an update on that at the turn of the second half of the year. We'll update on how our predictions are doing. Let me leave everybody with this, just a data point. We know that historically speaking, the best days in the stock market follow the worst days in the stock market within 2 to 8 days. So let me say that again. So the best days in the stock market follow the worst days in the stock market within a mere 2 to 8 trading days after those worst days. Crazy.
Yeah.
And so that's, and we saw that. We certainly saw the second best day on record in the NASDAQ and the 7th in the S&P, whatever. Good days following those worst days. We have to just look at this objectively, and that's what our clients are paying us.
Yeah,
to do.
I think we should be proud that no one under our care went to cash during that.
Oh, absolutely not.
Yeah, down period.
Yeah. All right, we'll leave it at that. Thanks everybody for tuning in. And again, be sure to check out our written commentary on our website. It is in the Insight section under Market Commentaries. You'll see it there, as well as this all will be in your inbox, available on YouTube and anywhere you listen to podcasts. Thanks everybody for tuning in.
Thanks, Chris.